Okay, so in this video, I'm going to address some of the settlement options for how a life insurance policy can pay out. So the first and simplest version is just a lump sum payout. So um, if the overall benefit upon the death of the insured individual is, say, $1 million, lump sum payment basically means congratulations, whoever the beneficiary is receives $1 million. Now, that can also be done in some different ways. So we could also do an interest-only scenario in which the beneficiary essentially keeps the, say, $1 million on deposit with the insurance company and receives only the interest on that. In order for that to work out well, then you'd have to list a contingent beneficiary for who is ultimately going to get the money, perhaps when the primary beneficiary has died, and then basically the contingent beneficiary gets what's left in the account. So you do sort of an interest-only approach. There's also a variety of different annuity payment options. And again, if with the annuity payment options, there's going to need to be a contingent beneficiary that's listed. And that'll come into play in some interesting ways for a few of them. So for the fixed amount annuity option, basically what happens is the payout or the payment that would be normally paid out is instead used to purchase an annuity or place an annuity, and it's going to produce a fixed amount of payment every period. And so for that fixed amount every period, some of that payment that the beneficiary is receiving is coming from the original sort of payout, but some of it is coming from interest on that. And so the interest portion, so how it's grown while it's been in the annuity, that portion would be taxable. And so then the original sort of benefit, death benefit, would not be taxable, but the interest that's being received on that would be taxable. Another way that an annuity payment could be done would be life income, that basically says that this life insurance payout will be used to generate an income for the life of the beneficiary. Now, that does create some risks as it relates to how much is going to wind up being paid out, but we'll talk about an option here in a second that'll address that. An annuity could also be done with a fixed period. So with a fixed period that basically says, all right, the annuity is going to pay out basically a certain amount or pay out a specified amount per period during this period, and then that's it. Everything's done. So that would be another approach. Then we get to back to the life income idea. So the life income with period certain. And so the idea behind that would be, let's say we sign up for that, that life income annuity upon the death of the insured individual. And so somebody's going to receive sort of income for life. Well, if that person, let's say it was $1 million policy, and that person's getting some, getting a payout, and they thought that person was going to live for the next 30 years, and the person dies a year later. Well, then a lot of money didn't get paid out. And so with a life income with period certain, the idea behind that would be, okay, it's going to pay out, and if that beneficiary, and if the beneficiary passes away prior to that, well, that we still have a period here, and we're still going to pay out across that period, basically, to whoever the contingent beneficiary would be in that case. So it basically sort of locks in, there will be a payout for at least this long. Okay. It just who is getting it could change depending on what's happened with those individuals. You could also do a sort of a joint and last survivor income. So you could have a situation in which there is a payout from a life insurance policy that is used to purchase an annuity. And for the annuity, it may pay a certain amount of money to, let's say, a married couple. And so basically they are receiving sort of a certain amount per year. And then when one of them passes away, then the last survivor may continue receiving an amount, but maybe a somewhat reduced amount. And so you could have sort of an income that's extending on with that annuity for that, but it's linked to both individuals, not just linked to one. So there's a sort of a last survivor that is still getting something, and when that person has passed away, then the annuity is over at that point. Okay, hopefully this video has clarified a few different ways that life insurance kind of payout could be structured, and hopefully that helps. Thank you for watching, and have a great day.